Welcome back to the conversation. Today, we are examining a fascinating intersection in the modern economy. We are looking at the exact point where traditional brick-and-mortar retail collides with cutting-edge artificial intelligence. It is a space where many legacy brands go to quietly fade away, overwhelmed by e-commerce giants and shifting consumer habits. But occasionally, a legacy brand decides to completely rewrite its own DNA. It is a rare phenomenon, and it requires us to look past the storefronts and directly into the data.
That is exactly right, and the market is currently rewarding those rare companies that actually manage to adapt. Today, we are dissecting Gap Inc., trading under the ticker symbol GPS. For the longest time, the overarching narrative around this company was simply about a turnaround. It was about survival. But looking at the data flowing in today, that narrative has officially and aggressively shifted from mere survival to high-level operational optimization. They are no longer just trying to stop the bleeding. They are building serious corporate muscle.
Let us unpack that shift in terminology because words matter immensely in the financial markets. A turnaround implies a company is on life support. Optimization, however, means they are fine-tuning an engine that is already running. And the primary catalyst for this upgraded engine seems to be their aggressive adoption of artificial intelligence for supply chain traceability.
That is the absolute core of the bullish thesis right now. They recently entered into a major partnership with a tech firm called Inspectorio. This is not just a public relations stunt to throw the word AI into an earnings call. It is a massive structural upgrade. Imagine a global retail supply chain as a giant, tangled ball of yarn spanning dozens of countries. AI acts as a digital comb, straightening out every single thread. It identifies exactly where raw materials are, where manufacturing delays happen, and precisely where costs can be eliminated.
It makes you wonder about the broader social and philosophical impacts of this shift. We are witnessing the real-time automation of logistics and decision-making that used to require thousands of human hours and human intuition. The financial efficiency is undeniable, but the underlying cost is a fundamental shift in how human labor and legacy knowledge are valued in the retail sector. We are trading human instinct for algorithmic precision. Yet, from a purely market-driven perspective, Wall Street absolutely loves this kind of ruthless efficiency.
They do, and you can see exactly why when you look at how it translates to the bottom line. Because of this optimized supply chain, we are seeing significantly better full-price selling and major gains in average unit retail. That means they are no longer relying on desperate, deep discount clearance sales just to move excess inventory. Customers are actually buying the clothes at full price because the right inventory is in the right place at the right time. The brand positioning is resonating again, and they are managing their inventory like a tech company rather than a traditional mall retailer.
However, as objective analysts, we must address the elephant in the room. When a company is supposedly executing this flawlessly, human psychology demands we ask, why are the insiders selling? The recent data shows notable insider selling, specifically around 120,000 shares offloaded by key figures within the company. For many retail investors, that immediately triggers panic.
It is a very common red flag, but context is everything in the markets. When we analyze the overall news sentiment, we see a very clear divide. The sentiment sits at a robust 73% positive versus only 27% negative or neutral. The positive news is entirely structural. The AI integration, the margin expansion, the operational efficiency. The negative news is almost entirely transactional, specifically those insider sales you mentioned.
So you view this as standard liquidity management rather than a lack of faith from the executive team.
Precisely. Think of it like a professional poker player who just won a massive hand. Taking a few chips off the table to pay for a mortgage or diversify their personal portfolio does not mean they think they're going to lose the next round. It is just prudent financial planning without any accompanying bad news about the company's strategy or forward guidance. The broader market is easily absorbing these insider sales. It is a non-issue disguised as a headline.
That is a very measured perspective. Let us pivot from the headlines to the fundamental analysis. The underlying financial health of a company provides the ultimate safety net for any investment narrative. How deep is the foundation here?
The fundamentals are incredibly solid, perhaps surprisingly so for a legacy retailer. We are looking at a return on equity of nearly 40%. That is a staggering number for this sector. It tells us that management is highly effective at using shareholder capital to generate real profits. Combine that with a low debt-to-equity ratio of 0.75, and you have a company that is absolutely not burdened by crushing interest payments. They have the financial flexibility to keep investing in that AI technology.
They are generating tangible cash as well. A free cash flow yield of around 8% gives them a significant buffer against macroeconomic shocks. Even if consumer spending slows down, that cash generation provides a deep margin of safety.
Exactly. And the broader institutional consensus completely agrees with this assessment. Out of 14 major financial firms covering the stock, the overwhelming rating is a moderate buy. More importantly, their fair value target sits much higher, generally in the $26 to $27 range. Given that the stock is currently trading around $21.90, the math implies a very significant upside for investors who get in now.
Let us translate this fundamental strength into the technical landscape. A fundamentally great company can still be a highly frustrating investment if the timing is wrong. Where does the stock stand right now in terms of its actual price action?
The technical setup is beautifully constructive right now. The stock recently staged a clean breakout above the crucial $21 resistance level. It is currently holding strong above its 50-day, 100-day, and 200-day moving averages.
For those listening who might not spend their days analyzing candlestick charts, think of moving averages like a safety net or a staircase. When the current price is consistently stepping above those long-term averages, it confirms the stock is confidently walking upstairs rather than falling down an elevator shaft. It proves the trend is your friend.
That is a perfect analogy, and the underlying momentum indicators fully back this up. The relative strength index is currently sitting at 58.7. That means the stock has strong, bullish momentum, but it is nowhere near being overbought yet. There is still plenty of room for it to run before buyers get exhausted. Furthermore, the MACD indicator is positive and rising, acting like a speedometer showing that the stock is actually accelerating. Plus, trading volume has been very healthy during these recent price increases, which confirms that heavy institutional buyers are stepping in to support the move.
It is a remarkably compelling picture. We have a legacy brand utilizing modern artificial intelligence to widen its margins, supported by exceptional cash flow, and confirmed by a bullish technical breakout. But every investment carries inherent risk, and the market is notoriously unforgiving to those who operate without a strict plan.
Which is exactly why having a disciplined strategy is non-negotiable. Based on all the exclusive data and metrics provided by US Stock Picker Podcast channel's name, US Stock Picker Podcast, let's break down the actionable conclusion for our listeners today. We have 6 specific points you need to write down. First, regarding the new sentiment analysis. The sentiment is highly bullish at 73% positive, heavily driven by their successful AI supply chain integration, which is fundamentally transforming their business model.
And second, regarding the fundamental analysis?
The fundamental analysis reveals a deeply undervalued company. With a return on equity of 40%, low debt, and strong free cash flow, the stock is fundamentally mispriced at its current levels, easily justifying the analyst fair value targets of $26 to $27.
That brings us to execution. What is the recommendation of when to start investing?
The recommendation of when to start investing is right now. The stock has successfully confirmed its technical breakout above long-term resistance, meaning the upward momentum is already in motion.
And specifically, what price point to start investing at?
You should look at starting your position around the current $21.90 level. Alternatively, if the broader market dips, you can buy on a slight technical pullback to the $21 to $21.20 support zone to maximize your risk to reward ratio.
But we must always protect our capital above all else. When should an investor leave the market?
You must leave the market immediately if the bullish thesis is invalidated. This happens if the stock loses its upward momentum, fails to hold its moving averages, and breaks back below its structural support levels. You do not hold and hope. You exit.
Finally, what price point to leave the market at to mitigate risk?
To strictly mitigate your risk, you must set a hard stop loss. If you are taking a shorter-term swing trade, leave the market at $20.90. If you are taking a longer-term position trade, give it slightly more room and leave the market at $19.90. If the price hits those exact levels, the trade is over.
A mechanical, emotionless approach is the only way to survive the financial markets long term. The evolution of this company from a struggling mall staple to a data-driven, optimized machine is a testament to the power of adaptation. It leaves us with a profound question to ponder. As we look toward the next decade, will there be any traditional businesses left? Or will every surviving corporation simply be a technology company that happens to sell clothes?
That is the ultimate question for the modern investor. You either adapt to the data or you become obsolete.
Thank you for joining us for this deep dive. We will see you next time.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. One shocking retail stock using AI to explode in 2024. Buy now.